G'day, welcome to Lunch Money at this new and improved time of 9 o'clock in the morning today, Australian Eastern Standard Time. My name's Nick Samios. I'm the fund manager here at Hermes Capital, and I am your live stream host here at Lunch Money. This morning, or today for lunch, we've got Mark Robinson, who is a partner at De Vries Taylor, and Mark's a restructuring expert. And I thought that we would kick the year off with a little discussion about what the keys are to success in 2023 when it comes to restructuring, small business restructuring, etc. My coffee's just arrived. Thank you very much. If you could close that door, that'd be fantastic. Okay. Delicious. So there's a number of challenges. Obviously, there's interest rates that are going up. We've got inflation. There's still supply chain issues that we've talked about for the last couple of years. The banks have started getting active. The Australian Tax Office has started getting active. I've been talking to a lot of equipment finance brokers. They've been quite busy, most of them, since the new year began. Property finance guys seem to be coming off the boil a little bit. In our space, in the distressed funding space and in the cash flow debtor finance space, we had a very quiet COVID, but then it picked up with a vengeance towards the end of last year, and everyone then seemed to go on holiday. So people are just shaking off the sand that they picked up at the beach, and they're coming back soon. But without further ado, I'm going to introduce you to Mark Robinson. G'day, Mark. How are you doing?
Nick. Yeah, good, thank you.
Very good. Now, Mark, you're a partner at De Vries Taylor there. You do all sorts of corporate restructuring. You do a bit of informal advisory, as well as obviously, voluntary administrations, etc., etc. Tell me, have you been busy lately?
Look, we're getting busier, I guess is the best way to term that. Certainly, it's a busier start to this year than like period last year. Inquiry levels are certainly well up. Conversion of those inquiries into assignments is improving, but coming off a low base. I guess that's the best way to summarise it, Nick.
Yeah, it's interesting because I think that our businesses are parallel in many ways. I mean, obviously, what we do is very different. You provide advice and we provide money. But it's interesting you talk about conversion rates, because for that whole, COVID coma that we went into, certainly in our businesses, the conversion rates were terrible. I mean, something would cross your desk, and and you experienced the same thing. I must say that since about August of last year, running into Christmas, we were probably, our conversion rates were better than they've ever been. So now, having said that, like I said, we've gone into a little bit of people are still sort of yawning after their January holidays.
Yeah, I think that's reflective of the fact that a lot of business proprietors of SMEs, which is my area, that are having issues. A lot of directors are identifying that they do in fact have an issue, that they are seeking lots of advice and from a number of different parties. But in terms of having a catalyst or a call to action that will force them to actually make a decision, that's still a little bit lacking out there in the marketplace. Whilst interest rates have gone up, the actual impact of those rises are yet to be fully felt. Whilst the ATO is more active, they're still well below pre-COVID levels in terms of court applications and the like. So I think just the catalyst or the requirement to actually take action on those issues is still a little bit lacking.
It's interesting you say that. I mean, you've picked up on a couple of points there. I mean, one is triggers for action, and the other thing you mentioned was people do shop around for advice, don't they? I mean,
absolutely.
They come to you, and you tell them what they don't want to hear, and so then they go and talk to someone else who may be a little bit less scrupulous and tells them what they do want to hear. But in the end, what you said was going to happen ends up happening. I mean, it's the same with us. I mean, I had a friend in our game, Louis Hajar, who's a bit of a legend in our industry. I don't know if you knew Louis, but he used to say, "Do your shopping first. Do your shopping and then come to me." But so that now the other thing you mentioned there were triggers. So you don't think the triggers are like the triggers for a small business or a large business for that matter taking action? You know, sometimes it might be they've won a new contract and they need to clean up. And I'm finding maybe they need to buy some new equipment, and you know, because of some blots they've picked up through COVID on their credit file. You know, all of a sudden they're coming to me for new equipment. So that's a trigger, and obviously then there's pressing creditors and the ATO taking action. You're not seeing so many of those triggers?
Well, look, you know, they're obviously not calling me for finance for expansion and or new equipment, for example. They're more calling me about issues, and as I said, triggers such as ATO stat demands and or director penalty notices. Whilst they're coming off a low base, there aren't that many out there. You know, they're still working through the savings and other benefits that they might have had through COVID. So there's still a bit of a buffer, a bit of fat there to work with. So there's still a fair bit of shopping around going on, as opposed to taking action.
Right. It's interesting. I mean, in December, I had 3 different files cross my desk. They were all businesses turning over in the order of $50 million. They were all in the construction industry, actually, funnily enough. They all had tax debts, just eye-watering tax debts, you know, 15 million, 20 million. Like, these things are just extraordinary. Now, 2 of them ended up in receivership before I could sort of get there to do anything. I mean, I tried to get in front of their bankers to talk to their bankers, but their advisors knew better. The other one, I'm not quite sure. It's managed to sort of skate along, but like the tax debt out there is massive. I think it's underreported, to be honest with you, because I can't believe some of the files that I see.
Oh, look, I think you know, the huge amount of tax debt is actually reported, but just what we need is more action on recovering that overdue tax debt. And having said that, that's on one side of the equation. I've also got to say that my experience is the tax office. If you on behalf of directors, if you've got a reasonable plan to address that tax debt by a combination of a repayment plan and maybe remission of penalties and the like, and you might as well shoot for it, but you mightn't get it, a bit of a trim of the actual underlying debt, that the ATO is receptive to those sort of commercial negotiation, as long as it's backed up by some good solid financials and a plan of action in terms of funding debt and equity injection and maybe a bit of restructuring if necessary to make it a more resilient business and a good taxpayer going forward.
Tell me, I'm just curious, one of the other phenomena about that have come about during COVID, because there's been so much cheap money, there's been a proliferation of lenders, particularly in the mortgage space, but also in the so-called fintech space. And we finding, where our deal size is pushing up because in the lower levels, sort of sub $500,000, there's just too much competition from these guys that are lending based on algorithms. These algorithms are, they scrape data from bank statements, from Xero, et cetera. They make quick lending decisions, there's no doubt about it. They can't make decisions on distress files. But what I do find is that there is this phenomenon of stacking, so that, we'll see a file, someone's after some money, and then there'll be 3 of these fintechs all lined up there, all wanting to get paid out. Are you seeing on the files that you get to, like a bunch of lenders that you've never heard of before that you need to deal with?
Oh, well, I've certainly, I'm seeing a bunch of lenders in that space that you describe, but certainly have heard of them. I guess, it's in my business and my profession's business to, try and keep across those lenders, and if you can, establish relationships with them, albeit that they're widespread, many and varied. And as you say, they keep their management structures very thin and have a lot more reliance on algorithms and AI and those sort of tools. So their perceived need to establish a relationship with restructuring and insolvency people such as myself, they consider to be a bit diminished. But getting back to your central question there, Nick, yes, seeing a lot more example of those SME style platform lenders.
Okay, well, let's get to the nub of our topic today. I mean, what do you think are the keys to successful restructuring in 2023 in this new sort of environment we're finding ourselves?
Well, look, I guess my first statement, which would apply to restructuring and has always applied to insolvency and restructuring, is to act early and seek professional advice. I guess that'll equally apply in 2023. It goes without saying, a business that understands its options and seeks professional advice to assess those options and then, if necessary, implement those options, has a much improved prospect of not only surviving but thriving. Drilling down more generally into restructuring, I think the kit bag of tools that we have will be the same in 2023, but maybe more emphasis on some of them. I think there'll be more emphasis on, maybe seeking, creditor moratoriums if required, and maybe in the background they're utilising the Safe Harbour regime as additional protection for directors whilst they have those negotiations with creditors. Similarly, within that environment, seeking creditor moratoriums and the like. And I guess more in your space there, Nick, as where the interplay of insolvency and restructuring practitioners with, nimble and agile financiers such as yourself is looking at optimizing the funding mix, in terms of debt refinancing, debt consolidation, also looking on the equity side as to whether there can be, issuing of more equity in return for receipt of capital, and those sort of things.
Let's just step through some of these. One of the first things you said was acting early.
Yep.
And there's certainly been impediments to people acting early over the last couple of years because they haven't had those triggers. So, I mean, is there, what are the triggers for acting early going forward versus what we've seen recently?
Well, from a director's point of view, is threat to personal liability, such as director penalty notices, and also if they are in fact insolvent, personal liability for insolvent trading. That's definitely a trigger that can hit home. Also, particularly, if security provided for the business are things such as the matrimonial home, and the like. I guess that another significant impediment to seeking help early is psychological, rooted in behavioural economics and the like. It's just human nature, to try and avoid difficulty and maybe not confront it. And so I think, directors need a bit of introspection of their own rationales and get real and address the problem at hand and not procrastinate.
Now, it's interesting. I've got a news article here because one of the other points that you made was you mentioned, we'll come back to creditor moratoriums because I'm very interested in that. But you also mentioned Safe Harbour. Now, there was this article, again, Clough Engineering went bust recently. They were looking to sell their business and that was all the news. And then all of a sudden, insolvency practitioners were appointed. Interestingly enough, the people that were going to buy them, I can't remember what they're called, something or other, Chinese concern. WeBuild, that's it. They're going to end up buying them in any case, and I dare say it's going to be for a lot less than possibly what they were talking about before the insolvency event. But it emerged in this article that they had been they had sought safe harbour protection. So tell me a little bit about, you mentioned earlier before we went live that you are seeing a little bit of safe harbour in the SME space. I mean, can you tell us, just give us a little thumbnail of what safe harbour is, and then tell me how it's applying to small business?
Well, small business, firstly, when I say small business, it's got to be towards the upper end of small business for safe harbour to work, because you've got a couple of threshold issues to deal with. Is essentially you've got to have all your employee entitlements paid up to date, and you also have to have your tax lodgements up to date as well, which for smaller SMEs can sometimes be problematic. And if they can't attend to those things, they can't even enter through to the gate to commence the safe harbour process. But what the safe harbour process is basically about is engaging with a professional to determine a plan and a way to work through the current financial difficulties that would result in a better outcome than a formal process such as voluntary administration or liquidation would result in for the stakeholders in the business. And if there is a proper plan there and it's properly implemented and properly monitored on the way through, you are said to be in safe harbour.
Now, what's interesting is that this obviously would have come as news to a lot of people that Clough were in safe harbour. I guess it's one of those things where when you see it, it's not surprising, but obviously, but in retrospect, it's not surprising. But one of you mentioned before about psychologically people don't like to seek help early. It's just a part of human nature. But one of the whole points of safe harbour is that you don't have to tell the world about it. So it wasn't published anywhere that the Clough were in safe harbour. I mean, it's something you don't have to even declare to the stock market or anybody. And some people say, oh, that's terrible, you should have to declare it. But the whole point of not declaring it is to avoid the embarrassment so that people do seek help earlier. I mean, is it also helping in that regard when it comes to small business? I mean, are they seeking help earlier because they don't have to go public and advertise their issues to the...
Oh, look, I'm yet to see, or I can't point to proof that safe harbour has, increased SME businesses, seeking help earlier. Predominantly because those threshold issues, being payment of employee entitlements in full and having their tax affair lodgements entirely up to date, are impediments to them entering that regime, and that particularly affects SME. And also the general is still a bit of a lack of awareness in advisors to small business. In that, I mean, tax accountants, advisors to small business, and general commercial lawyers. There's a little bit of still a lack of awareness of the ability to enter into safe harbour and what benefits that they can provide to directors and the business generally.
Because I guess the idea of safe harbour also is to protect the directors so they can't be sued for insolvent trading. The business has got issues, and before there was safe harbour, you may say, well, if I keep trading insolvent, then I'm potentially at risk of losing everything. But now, if I enter safe harbour, at least I can try and save the jobs, save my relationships, and save what I owe creditors, etc.
Sorry, just to cover off on that, the other benefit of safe harbour is not just to encourage directors to come forward, but also in that environment, if a proper plan is put in place early, it's for the benefit of all stakeholders and preserving value in the business. So that's another primary outcome of a successful safe harbour regime.
Yeah, I saw a quote the other day. I'm going to forget it now. Something about the plan is useless, but the process of putting the plan together is indispensable. So certainly forcing people to put a plan together makes them think. Now, another thing you mentioned there was creditor moratoriums. So are you talking about informal arrangements? Is that what you mean by that? So a business has got some issues with its creditors, and rather than go into voluntary administration, and look, I mean, we talk with a lot of finance brokers, and they hate the idea of voluntary administration for their clients because
absolutely.
they perceive it's going to make it hard for them to raise capital.
Mm.
The next time the client needs a piece of equipment, the bank's going to say no, etc., etc. So tell me a little bit about creditor moratoriums. Have you done any of those of late, and what do they look like?
Yeah. Oh, look. Firstly, your comment's spot on. You got to explore all your informal means to restructure and seek help. Before you press the trigger on the formal solutions, such as voluntary administration and the like. If you can successfully get an informal moratorium and restructure across the line, that's going to be best for the business and all stakeholders. Typically, informal moratoriums with creditors, they're best achieved if you've only got a few major creditors to negotiate with, and you can clean up and pay out essentially the minor creditors, because in an informal process, trying to herd the cats and keep the cats together and get them to all agree at the same time becomes exponentially harder the more creditors that you have to deal with. So I've typically found does work in SME, particularly where ATO and maybe one or two key suppliers are the major creditors to the business, and you've got sufficient savings and cash reserves to clean up the minor creditors. That's a good recipe for a creditor moratorium in an SME business.
And these creditor moratoriums, are they compatible with the Safe Harbour?
Yes, yeah, they are, and they could well be part of the Safe Harbour plan.
Yeah, because obviously, there's still this ongoing risk of insolvent trading, so the director wants to avoid that. Look, we won't go down the rabbit hole of preference payments and all that sort of thing that creditor moratoriums might uncover. All right. Now, the other thing you mentioned there was equity. So, are you seeing either formally or informally, new partners coming in, or the suppliers? I mean, who are these equity providers? Is it mum and dad? Is it a supplier? Is it a private equity firm? What are you seeing, and how does?
Look, I'm seeing private equity more in startups where there is, whilst there might be some financial difficulties, there's still some blue sky to shoot for. That is, blue sky with some real prospects that attracts private equity, albeit that that pool is diminishing at a pretty significant rate. If we've got directors or shareholders looking to put their funds in, rather than equity, I'd much prefer the process of putting it by way of secured debt. And that security being noted and registered on the PPSR, such that not only secures that injection, it also gives those new fund providers a bit of leverage if a formal process needs to be engaged with, like a voluntary administration down the track. They have the extra power and influence of a secured creditor rather than as an unsecured creditor to get the appropriate outcome through, let's say, a deed of company arrangement.
Yeah, I always say if mum, dad, or the brother, or the uncle, or the guy at the pub wants to lob some money into your business to help you out, always take security. I mean, even if they're taking equity, still put most of the money in as debt and take security and protect, because that way they might get their money back and they might be able to help the business again. Whereas otherwise it's just money into a black hole. Okay, look, so we've talked about taking early action, creditor moratorium, Safe Harbour, and equity. I think we went through all your points.
In terms of general things to look for, there are other motherhood sort of well-known areas of restructure which I don't propose to talk to. I guess you're more looking at, let's see what happens in 2023. There might be worthwhile spending a bit of time on different industries in terms of what 2023 might look like for them in terms of insolvency and restructuring.
Well, we've seen a plethora of businesses in the construction space. I mean, I guess there's two reasons for that. One reason is that we specialise in progress claims, so naturally we're going to see that. But secondly, there just seems to be a lot of tension in that industry with fixed price contracts, et cetera, et cetera. So I guess that's going to be the first cab off the rank for you when we're talking about industries to watch.
It is. I guess retail is going to come up a fast closing second, but I guess you've hit the nail on the head there, Nick. The main issue with there has been fixed price lump sum contracts entered into pre-COVID are now out of the money, and I guess in terms of the restructuring sort of issues to focus in on in 2023 there would be as to whether if that contract's still on foot, whether you can renegotiate it to something that's more equitable from the builder's perspective, particularly utilising the leverage that the principal or sponsor is going to want to avoid replacing builders and the current builder and key contractors purely because of the extra cost and delay that would be incurred in doing so. So I think there's that opportunity, and of course the other opportunity in that space, which you've touched on, is funding progress payments, because quite often what you find in those fixed price lump sum contracts is that even when the funds are due and payable, it's not matching the cash flow cycle of the builder, and so getting advance payment under progress claims is quite often what's needed to address cash flow holes.
Yeah, well, we certainly you're talking our language. And you mentioned retail. I mean, retail's always a bit of a battle. One of the interesting things during COVID, people have changed their shopping behaviours as well. More people are going online. There's fewer people. I don't know what it's like. You're in the city, in Sydney City. I know you've got another office out at Parramatta. A lot of those buildings are still not full. People are working 2 or 3 days a week. So that kind of retail has changed. What sort of retail have you been seeing?
Well, yeah, certainly during COVID, it was happy time for retailers. People weren't travelling. They had during COVID, surplus cash. Significantly more time on their hands, either working from home or not doing much at home, and so there was that cash boost. To occupy time, it was pleasurable activity as well. But that sort of obviously in the return to work and those and opening up of the borders, that available discretionary spend is drying up, and also households have now been confronted with increasing costs from inflation and rising interest rates, which is being reflected in declining consumer confidence. So basically, all of that sort of points to me at least in downward pressure on sales and through inflation impacting on retailers and employment supply constraints as well, increasing costs. So revenue and expenses, the arrows are going in the wrong directions in both cases. And also for retailers, they were sort of forced to move during COVID from a just-in-time sort of inventory method, which was favourable for working capital management, whereas now they've had to move to a just-in-case, bigger investment in stock, and because of declining sales, they're probably now faced with stock overhang, stock surplus. So they've really now got to push to move that on, to create a bit of a cash buffer to help them through, these more challenging economic times during 2023.
Look, that's I mean, this bullwhip effect through the supply chain, where you're right, where it was just in time, then it was just in case, and then people were filling up their warehouses. But now we've got rising interest rates, so the holding costs are going up. You do have falling demand. You've got the prices getting mucked up with inflation and what have you.
Mm.
And, you know, I do wonder whether or not that's going to be a deflationary pressure as people try to adjust their inventory levels, but who knows? Listen, we're kind of coming towards the end of our time. I just had a couple more news articles that I wanted to just get your thoughts on. One of them is, this is in today's paper, why non-bank lenders face being squeezed out. Now, the problem is that there's non-bank lenders and there's non-bank lenders. So what this article here is talking about is interest rates. As interest rates go up, it puts the squeeze on non-bank lenders, particularly, I suppose, highly leveraged non-bank lenders. Like non-bank lenders have borrowed a lot of money themselves, are going to feel the pressure. Do you deal with many non-bank lenders?
Yes, we touched on that a bit earlier, in terms of those SME business sort of platform lenders. They're very much in that space where they've got wholesale funds that are a cost to them and the rising cost. And, now, the advantage is swinging towards the big four banks again. In terms of their cost of capital, because of their big depositor base is improving, and you're also seeing a bit of retraction of private equity wanting to extract themselves out of tech deals and the like. They've typically been pretty heavy users of the non-bank space, so that demand is lessening off there some. That's what I'm seeing.
All right, then another article out of today's paper is this one here. This could be as good as it gets for banks' bad debts. So the ANZ declared, what do they say here? The pain from rate rises is looming, but ANZ's improving bad debt position shows the bank's starting position is strong heading into a slowdown. Just a day after ANZ Chief Executive Shane Elliott warned interest rate rises are about to push borrowers into very difficult times ahead, the Melbourne Bank's December quarter update surprised analysts by revealing its bad debt position and asset quality has got even better. That's the reality. I mean, the bank's looking pretty good. I actually think that part of the reason that the banks are looking good is because their more problematic exposures have probably been pushed onto the balance sheets of non-bank lenders. I don't know how that gets measured or if anybody's measured that. But what are your thoughts there on that?
Oh, look, obviously it's a true statement. Also note that ANZ has a bigger bias towards the institutional end of town. I think, the big end of town in terms of borrowers are pretty well positioned to ride out, rockier times ahead because they've got deeper savings and the like. But I do think, down in the SME space, the small end of town, so to speak, and lenders into that space will be facing different prospects to the ANZ Bank.
Okay. All right. Well, look. Any other closing thoughts as we sort of charge on into 2023?
Oh, look, I guess I can just reiterate the old truism that if you're aware of or a part of a business, that's facing financial difficulty, act early and seek professional advice. Great
words. Act early, indeed. All right, Mark. Well, thank you very much for joining us in our first Lunch Money of 2023. Yeah, so very, very good of you to come along. You've always been a popular guest. So we look forward to speaking to you again. And thank you to our viewers. And we'll do this again in a month. Lunch Money is now monthly. So see you later. Cheers, Mark.
Thank you. Have a good 2023.
Cheers.
Thank you.
You too.
Bye.
Bye.